some of you have asked me to explain in more detail the weighted average accumulated expenditure calculation in Learning Objective 2. So in particular, some of you have asked, do we always use 12 as a denominator? Take, for instance, the situation where we borrow on March 1st some amount of money, and that's outstanding all the way throughout the year. And then let's say we borrow, in this case, money on May 1st, and that's outstanding 8 months of the year. So we get one that's outstanding 10 months and one that's outstanding 8 months. Should the denominator in this scenario be 12, or should it be 10? In other words, should we be using, for this first expenditure, should we say that that's been outstanding 10/12ths of the year? Or should we say, well, we didn't start spending money, or we didn't borrow money, or spend the money we borrowed until March 1st. So can't we really just say, like, the denominator in that case is 10? So you would do, in that case, 10/10ths, and for the borrowing below, 8/10ths? Well, not exactly, because the idea here behind doing this weighted average accumulated expenditure is to determine throughout the entire calendar year, or 12-month calendar year, how long a certain amount has been outstanding. And to sort of explain this in more detail, we need to kind of compare the different ways we can borrow money and the different ways that results in interest. So let me explain this a little bit in more detail below. It's always, for a short answer, it's always going to be 12. The reason why it's 12 is because we're essentially trying to determine an interest amount. In the weighted average accumulated expenditures, that's just a step in determining overall avoidable interest. So again, the question we're trying to figure out is how much interest we need to capitalize. Okay, so we are, say for instance, in our general ledger, we have some options here, right? If we're paying money on interest, yes, the cash is going out. But the question is this: should the debit go to, for instance, a building, if we're constructing a building, or should we just go ahead and record it as interest expense on our income statement? And this guy or this guy. So how much interest to capitalize, if capitalize anything at all? We can look at the total amount of actual interest and say, well, we can capitalize all of it. That's probably a good option, but the FASB says that may be a very aggressive option too. So we have to go through some steps. So do we capitalize interest? Well, first thing is first. One, calculate the avoidable interest. Then two, compare to actual interest. And then you want to choose the smaller. Capitalize. So the FASB doesn't like us, holding off expenses. FASB says, look, if we want to be fair about this, don't necessarily capitalize all of it, but don't expense all of it either. But if you're kind of looking for an in-between, these are the two steps we have to do to figure out overall whether or not we can capitalize all of it or some of it. In number one, if we look at problem number one, or step number one, the avoidable interest, we have to do a couple things. 1A, these are little arrows. 1A says, look, we need to calculate the weighted average accumulated expenditures. Then we have to, 1B, apply the interest rate. And then in 1C, we determine the avoidable interest. That's the result of 1A times 1B equals 1C. So That's the process. Then we compare 1C with, up above, to the actual interest, and we choose the lesser. Why do we do this, though? What is the whole point? Well, when you look at the weighted average accumulated expenditures, the idea behind this is we are sort of converting a loan, a bulk loan, a full amount borrowed into a line of credit, which is similar to saying a credit card. You can establish a line of credit with a bank for large amounts, just as you would a credit card with a credit card company. So you don't have to borrow the full amount of a loan. You can just go ahead and borrow as you need when you need it. That's a line of credit. Obviously, banks would prefer if you borrow the full amount right away because they will start charging you interest on the full amount right away. So let me sort of put this in perspective for you. Let's assume that you are a business and you're constructing some building, let's say. And if you kind of look at the overall timeline, you say on January 1st, you need to pay the contractors $50, and then say July 1st, you have to pay another $50. Okay, that's the second amount. In fact, let's go ahead and just make that sucker blue in that case. Blue, you're my boy. Red, come on, Kevin, why are you not working for me? Oh, Kevin's being a pain today. All right, borrow July 1, the other 50. Now, if we borrow the full amount, scenario number, let's do this. Let's talk about line of credit first. A line of credit would say that, hey, look, when you borrow the 50 on January 1st, interest will start being charged immediately on that. That's going to result in actual interest on that amount outstanding for the full 12/12ths of the year. So 50 times 12 over 12 times, let's say it's a 12% loan. That means my actual interest in this case would be how much? 6. Or $6, $6,000, whatever you want to call it. That's the amount of actual interest on that particular amount that's being borrowed and outstanding. When you draw another 50 on July 1st, the actual interest is going to be 6/12ths of the year, which is $50, that amount 50, times 6/12ths times 12%, which means that particular borrowing will result in $3 charge. So the total amount of interest, if we use a line of credit, LOC, the total amount of interest using a line of credit would be how much? $9. Okay. Now compare that to a rather unfortunate situation where we borrow using a loan, full amount. Okay. We take the $100, we borrow it on January 1st, and the actual interest is 12/12ths times the $100 times 12%, which equals 12. Ugh, that's not good. We prefer the line of credit because it will result in less interest charge. But what if, let's take a look, that's the actual interest, right? But let's look at that loan and let's calculate the weighted average accumulated expenditures, and let's multiply that times the interest rate to determine avoidable interest, as we did in Chapter 10. Because if I do this correctly, I'm going to convert essentially this full loan, the process of this full loan being converted into avoidable interest turns it into, by magic, a line of credit. We want to look at the full loan, not as a full loan. We want to look at the full loan as if it were a line of credit. That's what avoidable interest does. It allows us to look at a full loan in the perspective of a line of credit. So if I do the process that you're supposed to know in Chapter 10, Learning Objective 2, this means I have to, weighted average accumulated expenditures, the first $50 from January 1st, Jan 1, I want to multiply that by the percentage of the year outstanding, 12/12ths, which gets me $50. Then the second amount I borrow, July 1st, multiply that by 6/12ths. That gets me $25. Now there is a whole grouping part of this, of that topic. I don't want you to worry about that right now. The total weighted average accumulated expenditures in this case is 75. That's your Y. What do we do with that now? Well, just group that as one group and multiply it by 12%. Guess what that equals? $9 avoidable interest. Yes, the actual interest in this case, actual interest was 12. But the avoidable interest is 9. In other words, if we convert the full loan into a line of credit, then the interest, we can say, just from an overall calculation standpoint, changes from $12 actual interest into $9 avoidable interest, similar to a line of credit. And that's why the FASB says use the smaller amount. Use this. Because they don't want us overcapitalizing the $12. They say you don't have to expense the full $12 as interest expense, but you should not fully capitalize the $12. That would be too aggressive. Don't be too conservative. Don't be too aggressive. Be somewhere in the middle. So on our balance sheet, this is the question that started off the whole of that whole learning objective. Do we put it on the balance sheet or the income statement? Right? We can either say, look, put the full 12 on the income statement. That's too conservative. Okay. Option I. Option number 2, we can put the full $12 in interest on the balance sheet. That's too aggressive. Too aggressive. FASB says option 3, somewhere in the middle. In this case, we'll choose 9. $9 can be capitalized. The remaining $3 can be expensed. And that's the process of determining avoidable interest, how to compare that to actual interest, to determine what's the overall amount that we can go ahead and capitalize. And if we took this a step further, another way of looking at this is to say the amount that we capitalize approximates the interest we would actually incur, approximates the actual interest in a line of credit or credit card. That seems to be the more appropriate way. We're not going to do the full 12, not going to do 0, somewhere in the middle. What would it be like if we use a credit card? It would be 9, so capitalize 9. That seems more appropriate. If you have any more questions about this, or you want to know the rationale for why we do that, please let me know. But let's go back a second to the calculation above. The original question was, why do we use the full 12 all the time? Okay? So if I use a line of credit, okay, the actual interest equals the $50 times 12 over 12 times 12% plus 50 times 6 over 12 times 12%. We can rewrite this to say, look, this 50 is just 50, this 50 times 12 over 12 is just $50. And multiply that by 12%. And we can convert the 50 divided by times 6 over 12. Hey, that's just $25 multiplied by 12%. Or we can rewrite this to say, hey, it's just 75 times 12. That equals the actual interest in a line of credit. That's funny, though, because when we look at avoidable interest, we determined the weighted average accumulated expenditures were 75. That was what our YE was. Recall where that was down below? Where is that sucker? There it is. YE. Right there. YE 75. I'm just simply recalling that for you here. And what did we do with that? We multiplied it by 12%. That was the interest applied, the interest rate applied. So, see the similarities here. Avoidable interest, the calculation resulted in $9 avoidable interest. And in the situation of a line of credit, the actual interest equals 9%. So what's the whole avoidable interest thing? Again, avoidable interest effectively converts interest on a full loan into interest on a line of credit. If you have any more questions about that, please let me know. Cheers.